All right, welcome to our week in finance, or I shouldn't say finance, but in farm management. So, the idea is in this week, we're going to talk about an introduction and continue to add to our conversation on financial statements and managing those. But we're going to back up and keep talking about records. As a business keeps records, they are really documenting these financial transactions. So, before we can move into the financial statements themselves, which we have to talk about in this week, but we also really ought to keep focusing on accounting. So how debits and credits are handled in a book, in a set of books, and how the accounting is done is kind of the focus that I wanted to get to today. So take a look at this lesson, and hopefully you can take notes along the way, stop it and back it up, so make sure that you can keep up. It'll move kind of fast, but you ought to be able to develop your own set of notes for the week. Also make sure you look at the assignments that also exist in this week. Let's take a look. All right, so in this week, what we're talking about is financial records. And financial records really relates to several things that we talked about last week. A chart of accounts, that's how all these accounts are organized. The two types of records, so a cash basis or accrual basis records, and then what do we do with these records, the use of them. Really, we talked about several of those. And really the way we manage all of these records is what we finished with, and that's these T accounts. And it represents this concept of debit and credit. This idea of some accounts have balances on the left and some have balances on the right. And that is what we call a T account. And that relates to all the things we talked about last week. So really, let's continue on with that. That's kind of the goal. And so the goal is that these records are used in financial statements. And the two that I'm going to talk about to get us started, the main ones, are a balance sheet and an income statement, which is sometimes called a profit and loss statement. All right, so that's kind of what we did last week, and that connects us to this week. So let's start off with a balance sheet. What is a balance sheet? Well, a balance sheet is going to be an organization of assets. These are things we own, usually pretty simple to talk about. These assets are always equal to, they only come from two places. Liabilities, we borrowed the money to get them, or the other would be equity. Equity is the stuff that is, for now, I can say it's the things that we own. And we want to get more in detail of that. So let's carry each one of those down and talk about them a little bit more. But liabilities and equity always add to equal assets. All right, so let's talk about these in more detail. We can start, I think, with assets. They're the easiest to start with. Assets are, again, things we own. Like, what are some good ones? A bank account, money in the bank, savings account, checking accounts, trucks and equipment, land. These are things we own. And in every business, and even personally, you own these things. Well, how do you gain them? Well, one way is you could borrow the money, credit cards and loans. And the other way is that you already have the money. That's retained earnings. We already have it. That's money we've earned. Probably a better way to color that is green. But these are the things that we've earned, and that's the number one way we get it. Or someone could gift it to us, and that's the second way. That's called investor capital. If you're in a corporation, they invest money in you. That's how you get that money. So really, that's the balance sheet. Assets, things we own, have to equal to, hopefully, what we've earned, or someone invested, or we even may have to borrow. You want more equity than you do liabilities, of course, but that's the only way a balance sheet occurs. And it's always true. There's no other way around it. You get audited by the IRS, assets equal liabilities plus equity. There's no other way that it works. So really that serves as the basis of our lesson for accounting. So what are some examples we look at? Well, a truck, for example. If you bought a truck for $70,000 and you borrowed $50,000 to get that truck, then therefore you must have gotten $20,000 from either earnings, you already have it, or someone gave it to you as a gift or invested in you. Those are the only ways that can happen. Of course, equity is sometimes talk about the leftover money or the part we own ourselves, but really we own that because we either earned it or someone gifted it to us. That's the only ways that money actually takes place and able to happen. So the best way to look at this is to start looking at some records. So let's say that if we sell $10,000 worth of income, that brings us cash of $10,000. We don't owe any money on that, so therefore we must have earned $10,000. And so every time a transaction happens, it affects the balance sheet, which again, back to the idea, the balance sheet is a giant T account. That's all it is. So really that relates to this concept that I've already shared over and over, that assets equal liabilities plus equity, but that is a giant T account, what we've talked about before. So all the assets are over on the left, and they are all normally debit balances. Liabilities and equity, it's all on the right. It's normally a credit balance. So if you want your assets to go up in value, then that means you're going to put a debit amount into that column. New cash comes into you, that's a debit, it goes up. If you take money out, that's a credit, it goes down. Same thing's true of liabilities and equity. If you borrow money, that's a credit, it goes up, or you earn money, that's a credit. If you pay off your loan, then it goes down with the debit. If you lose money, then that's going to end up going down with the debit as well. So that's kind of the idea, and it's the core part of accounting. So really, accounting records, main decision that you've got to make when you keep records is just trying to understand what category does this transaction relate to. Transactions are things that happen in a business, like I sold some product today, or I had to pay my fertilizer bill today. These are normal entries. And so the best way to probably look at these rules this idea of record keeping is to look at some examples. So what are the rules? Well, of a balance sheet, the rule is simple, that debits always must equal credits. That's the only way the records balance or make sense. So again, examples are probably the best way to go about this. So let's look at some. And so the first one, we buy a new tractor with cash. So that's an $82,000 tractor we bought with cash. So that's a new asset. That's a debit. That's a new asset comes to our business worth $82,000. That makes our assets go up. But what's the credit? Well, the credit is you had to take out cash. So it really all affected the same side of the balance sheet. Money went up, assets go up with the tractor, money goes down. So really this is just an in and out of the balance sheet. And if you buy a new piece of equipment, it doesn't change your equity. Assets just went up or down if you use cash. So that's the idea of that first record. What's another example? And equity would be zero in this case. So what's another example? Well, we could borrow some money to buy this tractor, and we pay $52,000 down, we borrow $30,000. So that's kind of the idea. The cash is the rest. What does that record look like? Well, tractor is going to go up again in my assets, $82,000. That's great. How about my cash? Well, $52,000 went away. So that leaves $30,000 still there, but that's a loan. So that's going to cause my assets to go up by $82,000. My cash is going to go down, which leaves $30,000 of increase, but that asset equals my liabilities of $30,000 as well. So once again, equity does not go up. It's the same net result. It's not affecting equity. What does affect equity? Well, just like we talked about, equity is going to be retained earnings or investor capital, so sales would be a good example. So what if we sold $100,000 worth of hay, all paid in cash? What would that look like? Well, finally, we're going to affect our equity. We're going to have a debit again, and you have to have a debit, and that's going to be our cash on hand. So cash goes up by $100,000. That means our assets go up by $100,000. That's a good start. Question is, how did they go up? Well, how they went up was sales. So the credit is sales, which is an equity account in retained earnings. So what we are after, or what we are always after in a business, is how can you make equity go up? It's a simple idea. And that's going to be, in this case, make your assets go up, which is, in this case, is, of course, selling more. And then that's going to directly affect equity, which is kind of the idea of the balance sheet. So every time you make a financial record, you are editing the balance sheet. And that's what each one of these goes back to. All right, let's continue on through some more examples. Again, that makes equity go up, income, that's what we're after. So sales is a good deal. All right, let's go look at what it takes, because you're not always just going to sell things. Sometimes you're going to have to spend some money. And so that kind of brings us to our next example. So this cash that went up, that is a good deal, but it is maybe not something we always get. That's what I'm backing up here. Accounts receivable is a way we could sell product and not actually get the money. So this would be an example where cash is not what you get an accounts receivable, but that's also an asset. So whether we get the money in cash or someone does it as a receivable, it's still a positive equity move for us. Okay, so now where I started, that's to talk about spending money. So let's say we spent $20,000 on fertilizer and we had to pay it up front in cash. So that money we earn, we now have to pay for things. So the opposite of income is an expense. So we're going to debit a fertilizer expense category, and then we're going to credit cash because cash had to leave. So this starts now getting into using equity a lot. Our sales is the opposite. That's a credit, meaning equity goes up. That's good. Well, expenses are negatives. That makes the income go down. So then, therefore, that must be a debit to bring equity down. So fertilizer expense is going to be $20,000. Cash, it goes away. It's a credit. That's going to be $20,000. So in this case, that's bringing our equity down. Hopefully we sold enough to pay for this. That is the idea. All right, so let's keep going through some other examples really quickly, and hopefully you'll follow the idea. Accrual. We didn't pay cash for the fertilizer. In this case, we took it on an account. So we paid on an account. So you come through here and the question is, we didn't pay for the fertilizer. We're going to pay for it later. So instead of having to pay cash out, you can see in the example here, we still have fertilizer expense. Let's say it's, get that off. Let's say it's $18,500. That is our expense. And so you've got fertilizer expense, $18,500 to debit, just like we had before. It's an expense, just like we did before, no different. But now we have an accounts payable instead of cash. So the idea is assets always equal liabilities and equity. The $100 that we get in assets, if we borrow 20, then we must have made 80. And so that's kind of the net effect of a balance sheet. Equity is a very important part of the balance sheet, and we've been talking about it. So let's talk about the second statement, which is called the profit and loss statement. Profit and loss is going to have income. That's going to be a revenue area, credit. Anything goes up to our equity is called revenue. That's good. That equity goes up. That's good, good, good. But expenses mean that equity is going to go down, so therefore it has to be a debit. So net income, if you make money, then you end up with more credits. That makes equity go up, which means that's a good thing. Or if you have too many expenses, the net income goes down, which is going to be the opposite effect. All right, so there's an introduction to this idea of accounting. Accounting is really just a scorekeeping of how our business is doing. The chart of accounts is that organization. That's all those accounts that our business relates to. If we have different types of sales, there's different sales. If we have different types of expenses, there's different types of expense accounts. All of those flow through the balance sheet. That's the number one financial statement or financial record for us to look at. Now, once again, as the note said, net income is another important statement, but it's connected to the equity section of the balance sheet. So that's kind of an introduction to record keeping and how debits and credits work. Make sure to look at the assignment this week and the discussion and get that completed. Thanks.